All right, this is going to be a put option strategy, this particular webinar. One thing that I always say before these webinars is, especially if you're not very familiar with options and or this particular strategy, when you get sent this in your email, please go back and watch it again relatively soon after receiving it, because the first time through kind of goes over your, some things go right by you. Second time through will really make it sink in. In that regard, it's kind of a short-term memory thing on the first time through. Second time through pushes that towards your long-term memory, and you'll be able to remember it rather than a couple months down the road you guys go back and watch it again. It's going to be kind of like relearning it all over again. Anyway, my name's Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business, or the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for over 20 years now, and I'm not here to tell you that I'm going to make you rich or make you a millionaire, but I am here to help you learn how to take control of your finances, manage your portfolio, and most importantly, take control of your own risk. One thing, if you guys don't know what this shot was all about, this was about the rant that Rick Santelli had, and I popped in there and said that allowing these mortgage holders to not pay their mortgages was creating a moral hazard because there was no repercussions for their actions, and other people would jump on board and do the same thing even if they weren't in distress. So there's another moral hazard that goes on, and that's with the financial advisors. At the end of the day, we all have conflicting goals when we're dealing with a financial advisor. Our goal is to get the best or maximum return on our investment, where their goal is really to make more money on the commissions that they're getting. So whether that's the fees or whatnot, and that is a conflicting goal. They're taking away a lot of your yield. So at the end of the day, learning to take control of your finances and manage your own risk is paramount, because it will ultimately lead to a better situation down the road because of the fees that you're paying to that financial advisor will be well made up by you doing it yourself. Anyway, moving on. I've traded most markets throughout my career from the Chicago Board of Trade. I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of those products in all market conditions. Disclaimer I need to go over real quick. Any opinions, news, research, analysis, or prices, other information contained here or material provided by ProTrader Strategies, associate companies, or employees is for general commentary purposes only and does not constitute investment advice or solicitation to buy or sell any of the things that we talk about. In full disclosure, I may be holding a position in some of these different products, and I'm not trying to get you guys just to do what I'm doing, but to give you real life examples of strategies and trades that I find. At the end of the day, it comes down to do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, moving on. Now that we got that out of the way, this is going to be on put calendars, and this is a great strategy for especially the entry-level trader or investor for that matter. And the reason why it's good is because it's a limited risk strategy, and it's about a 50-50 probability of success is generally what it kind of boils down to, and you're risking one to make one, so those probabilities are in line with each other. You're not outweighing one or the other. So it's a great one to get your feet wet, and it's a great strategy to implement, especially during low implied volatility like we've seen. It has pumped up, yes, in the past few days, but for the past several months it's been relatively low, and these type of strategies work well with that, because then you go into that expansion phase of implied volatility, and that helps you out in the long run. So with this strategy, it's also, the put calendar is also a long horizontal spread, which a vertical spread is within the same month. Horizontal means you're going out across the calendar, if you will. We're going to be selling one at the money and buying one at the money or selling one out of the money in the near expiration and buying at the money, or sorry, the out of the money put in the further expiration. Let me just rephrase that. You're going to be selling the out of the money put in the near expiration, which is the near month, and then buying the out of the money put in the further expiration month, which means the next expiration monthly cycle. So you're going to either do the at the money, or the out of the money, out of the money. So what we're looking for is a directional assumption, and obviously we're going to be looking for a slightly bearish assumption in this, because the longer duration options contract that we're holding is a put, and that is a bearish position. So we do want the market to go down, but it is neutral in the sense that we don't want this to move too fast, too quickly. We want it to kind of be a slow grind sideways, maybe to up, because we want that front month option to expire worthless, which is one of the reasons why I like to pick the out of the money put in this calendar spread, because I want that option to decay out of the money as well in the front month. So if you're slightly bullish in the near term and bearish, maybe going a couple months down the road, you might opt to go to the at the monies. But generally speaking, I just opt for the out of the money right away. And the other thing is, we want low implied volatility when we're implementing this strategy, and we want it to really expand, because in volatility terms, it affects the longer duration months more than it does the front month. So with implied volatility expansion, it will help us out in the long run, because those further expirations will increase in value faster. And with the put calendars, that is a perfect scenario for that, because when the market goes down, volatility has a tendency to rise. So that will help us in that long duration. And we want high open interest in these options. Now, high open interest means there's a lot of players in there, and we get a tight bid ask. And I get asked this a lot: what is a tight bid ask? Well, something that's underlying of around $100, trading at around $100. I want those options contracts that are close to the money to be around less than 10 cents. So if it's $1, it would be $1.10 on the bid, from the bid to the ask. So something inside of that. If you're getting like 20 cents wide on something that's under $100, I usually pull that off my watch list and don't go in there, because the further out in time you go, the wider that gets. And when you have that wiggle room between that bid ask, it means you have to give up more edge to get in and give up more edge to get out. So that will eat at your overall return. So always go for the tight bid ask. If you're having to give up 25 cents, it's not liquid enough. And high open interest and volume creates liquidity. And we also, for what we want to happen, we want our correct directional assumption, obviously. We want this to trade sideways to down, and that's where we're going to be making our most money. And we want volatility to expand. For long-term options, we want it to have the greater sensitivity, or it will have the greater sensitivity to volatility. So given that, we want our volatility to be, implied volatility percent, to be less than 30%. And I'll go into the details of that when we pull up the trading platform, but it's just a ratio of where volatility has been in relation to where it is now. So we want it to be at the lower end of this underlying volatility historically, in a sense. And one thing I think I failed to mention, we're going to be looking to cover this strategy at about 25 to 30% of the debt paid. I meant to mention that a little bit earlier, but I'll go into that in more detail a little bit later. And we want to be able to cover this before the binary event happens, and most most regards, because as we approach that binary event, we're going to get that expansion and volatility. A binary event is maybe an earnings, and we want that to capture that expansion and volatility, which increases that premium, but not really take the risk necessarily through that binary event. You can, and I do that as well, but the optimal thing to do would be able to cover this for that 25-30% of what the debit paid was before that event. So if we paid 80 cents in that regard, we'd be looking to capture about 25 cents-ish, 26 cents on top of that. So if we paid 86 cents, add the 25 cents on top of that, that gives you about $1.10 where we would look to cover this strategy. And your max profit is unlimited. Now keep in mind, your max profit, I mean, it's unlimited in the regards that it can go to zero. The likelihood of that happening is not very probable. And that is only after that front month short option has expired, worthless. After that, if the market goes to zero, then that's your profit from where you entered the trade to zero. And, you know, it's in a sense unlimited, but, you know, it can't go below zero. And if you get twice the debit paid, that's like the best case scenario. So if we paid 86 cents and you can get out for $1.60, that's about the most you're ever going to make on this strategy. So, you know, in that regard, that's why, and it's very difficult to achieve that. I just look for the 25-30% of that initial premium paid to get out. All right. And our max loss is the premium paid. Anytime you're doing a debit spread, you guys, that is your max loss. So if you're doing anything for a debit, you can't lose any more than that. That's the basic 101 of options, is if you're doing a strategy for a debit, then that's the most you can lose. If you're just even buying an option for that regard, that is the most you can lose. And our break even is going to be the long put option less the premium paid. So because we need this to go down, if we're doing a 50 strike and we're paying $1 for the overall, our 50 long and that long duration minus that dollar, our break even is when the underlying is trading at $49. All right. One of the things we also want to see with this that happens, I want to show you a visual representation of this. We're going to be selling the option that has this type of theta decay, and then we're buying the option that has this type of theta decay. So the front is going to decay quicker than the back. So that will help us achieve our goal quicker, is when that front month starts decaying rather quickly right inside this 35 days, and we're right around inside of that wheelhouse. We can take advantage of that. One thing also for management purposes, we talked about covering this strategy at 25-30% of what we paid for that. So, you know, at $1.10, that's where we'd be looking to cover that strategy. The other thing is, if we're losing on this right away, we can roll out our puts, our short puts, through the expiration cycle. And that's another key component to having a lot of open interest and liquidity in these options contracts that we're getting into this with, because then we get those weeklies that we can roll that short out in time, collect some more credit, and increase our break even a little bit. The more credit we receive along the way, that brings our break even higher. So it wouldn't necessarily be 49 anymore. It would maybe be 48.50 if we were able to collect another 50 cents or something along those lines. All right, so without further ado, let's get into the platform. And this is about the time where I usually tell you guys, you know, go into the questions box. Feel free to put a couple of ticker symbols out there. I have some that I've vetted that I think are good ones that we can look at, but I like to kind of go through it with you guys, because if we can go through the steps on something I haven't vetted, maybe I'll be able to cover some more. And Sophie shoots it off with SPY. She saw me have it up there already. This is my SPY painful trade that I've had on for several months. I keep lowering my cost basis on it. That I did for a webinar a long time ago. But in that, so we would be looking to buy the puts here. So we're trading around 106.50. So I'd be looking to, oops, sorry, I don't want to buy those. I want to sell those. Sell the near term, because this is about 28 days to go. And then we'd go out to the further duration here. Close out the weeklies. Got all my weeklies open on all these. So we'd go out to the August, which has the further duration, and that's where we're going to want to buy this. One thing to look at, I also want to mention is when you're looking at these implied volatilities over here on the side, we want this to be relatively close, and this is setting up nicely because we have higher volatility. Oh, I thought it looks like we have higher volatility in this front month than we do in that further duration, which is a bit odd, probably because we've just seen that big move down and they're expecting it to normalize, which is good, because that means this premium that we're going to be selling is pumped up a little bit more than the premium that we're buying. So that is a great example of what we want. Generally speaking, the further durations are going to have the higher implied volatility. So in that, try and keep the difference less than 5%. Sometimes you're going to have the earnings landing out here on some of your straight underlyings, straight, stocks and whatnot. So try and keep that within 5%, because we don't want to be paying a lot more than what we're getting credit for when we're selling these. Okay, so this down here, excuse me, is the IV percent. So anytime I'm doing this strategy, I want the IV percent to be less than 30. That meets that, despite the fact that it has a bucket of goods. It's an ETF, which usually I'll lower that a little bit, but it'll work for this. And what that means is, like I was talking about with this IV percent, is where it's trading now in regards to where the IV has been. So that means it's in the lower quarter of where it has been in the past 52 weeks. So that would kind of fit that mantra there. So going through that steps again. So this is the one we're going to be selling, which is nice. And then the one we're going to be buying is a little bit further out. And we would be buying that one. And as you can see here, even though it's a $200 underlying, there's so much volume and liquidity in here that the bid ask is less than that 10 cents, and it's actually 6 cents wide, which is really nice. And you don't have to usually give up much and go mid-market, especially in SPY when there's trading as much volume and open interest as they have. I mean, this is just incredible volume and open interest. That's about as good an example as you can get of high implied or high open interest and high volume on any given. This is the daily volume there. So if you were just to come in and offer 366s, you don't have to go to the default of the mid-market. I would actually probably go a little bit further away and try not to pay as much. I'd probably go down 2 or 3 cents and then work it back up. And that's another key thing with when you're doing these options strategies and implementing different types of trades. If you put in a trade right there at the mid-market and got hit right away, you got to second guess what you just did almost. It's, there's a thing that goes back and forth. Do you want the penny or do you want the trade? Well, at the end of the day, put it in a little bit lower than you think and cancel replace it. Put it in again a penny higher, and you can do that successfully, as long as it takes you to cancel, replace. Either it's going to get hit or it's not. So you can cancel, replace, put it in again, cancel, replace, and put it in again, and work it that way rather quickly, just to make sure you're doing price discovery to get the best bang for your buck on that. All right. Okay, so that would be a great example of something to do, especially because this volatility is higher than the other one. And on this one, our most we can lose on this is $1.84. So I would be looking to cover this. 30% of that is somewhere right around 50. Let's say 55 cents, just for ballparking out of my head. So we would be adding that 55 cents to this, and that would give us about $1.30 or $1.40, let's say, for rounding off. I'm being asked, what is delta? Great question. And with this one, what delta tells you, it tells you a lot of things, to be quite honest. But the delta is for every dollar change in this underlying. So when this goes down, because we're talking about the puts right now, if SPY goes down from 206.31 to 205.31, delta adds into this. Now, delta here is negative because it is on the puts. These are positive, and it's on the assumption that the market goes up, and this would go down by 49 cents. If the market goes down, it's kind of a negative minus a negative equals a positive, right? So the 49 cents gets added into this for the first dollar move down. It also tells you that, for $1 move down, this is only being affected by 49 cents, which is, 49% of the underlying value in a sense. So if you're trying to hedge something, for instance, that's a hedge ratio also. So if I was long 100 shares of this underlying, if I did the put, then that would account for 49% of that portfolio in that underlying. The other thing is a floor thing that most people don't talk about, like online or anything else, but floor traders always use this delta as, it's the probability of being in the money at expiration by 1 penny is another thing. But on the floor, we would look at it as the probability of being tested on our strike. So in that, it's 2 times the probability of being out of the money. So 2 times this is the probability of being tested. So this would be, a 98% probability of being tested in the next 28 days. So in that regard, delta is also telling you this 196 strike has a 40% probability of the market coming down and just touching it or testing it and coming back away. It's only got a 20% chance of being in the money by 1 penny in the next 28 days, but it has 2 times that probability of at some point coming down and hitting it and maybe coming off of it. So those are all the things that delta's really telling you. That answer your question and anyone else's? And please ask any questions, you guys, because somebody else may very well have that same question come to mind as well. Okay. All right, so a couple other ones were Goldman Sachs. Nick coming up with Goldman Sachs, so let's close this one out. So Goldman Sachs, one of the things we're going to look at is the implied volatility percent. It's kind of high. All of the bank stocks have been getting beat up heading into the FOMC meeting because the probabilities of them raising rates were basically zero with the Brexit and everything else. So the bank stocks got beat up. So anytime the stocks are going down, the implied volatility is going to get pumped up. I don't know if you guys how many of you guys watch those same. Yeah, so the delta, so it's very delta neutral. So back to Sophie's question, she wants to clarify something. Yeah, this is a relatively very delta neutral strategy because we're doing the same at the monies, and because the deltas are going to have a tendency to be a little bit more in the further duration, but because this has the higher volatility in the front month, it's pumping that up a little bit more. So this would actually be a very delta neutral strategy, which means you're more neutral than you are to bearish, especially in the beginning of this trade. And that gets back to that whole thing I was talking about. We do want this to either trade sideways to maybe even slightly higher in the beginning and then sell off in the end, because we want that front month to really expire. We want that front month to expire worthless. And another cheat real quick, we could look at the 106 puts right here. If you go the ones that are about 35 days to expiration, and the most you could get basically for this overall strategy if that front month expired worthless would be right around $4. And that's goes back to that risk one to make one. Remember I said we're paying $1.86 or something like that. The most you could make is about $4 on the overall trade. And I don't have the time or probably even the expertise to go into all the math that goes into that, but that's a floor cheat that we used to use. Is you'd go to especially for the calendars, is you'd go to the 35 days to expiration, and that's basically what you could look at for your maximum profit on the calendar. So that goes back to that risk one to make one, but I'm not looking to do that. I'm looking to take about a third of that, so about 60 some cents or so. All right, so on to a couple other ones that we were looking at. And as volatile as SPY is, I don't know that calendar would be that great for this, especially with the pending Brexit coming up. So Goldman Sachs, let's get back to Goldman Sachs. So if you guys think that the Fed isn't going to raise rates anytime soon, that's really going to hurt the financials. So this might be a very good one. It could calm down, and heading into the next FOMC affect them, and it could really affect what their profits or what their earnings expectations are going forward. A lot of people might have been thinking there was going to be 2 or 3 interest rate hikes, and that would have helped the financials, because remember, they make their money off of interest, and now that could be blown out of the water. So that could work out. So we could go to the options chain, close all those up. We did discuss that this is a little bit higher than what I would like to see, because the idea is, if they've already seen this volatility, is volatility going to come out of it? And if volatility comes out of it, it's going to hurt my longer, I'm surprised they don't have the September options on Goldman. They usually trade pretty good. They'll get those on Monday though, because we just had triple witching. But in that, we want to look to these expiration cycles, and this looks a little wanky. If you wanted to roll it out further in time, you could. I'd probably stay away from it until maybe Monday, and I have a feeling that you're going to see a lot higher volatility in those September options, because they're going to have earnings falling in there. What happens, it's a limited, if I'm being asked, what happens when SPY expires at 105 or 107? If it expires at 105, those puts are going to be in the money, and it's depending on volatility. It's very difficult to ascertain that, I guess, if you will, because it really all depends on how volatility has affected those premiums. So you can't really, there's, you know, several different nuances that go into that. If it goes down right away, then, you know, if you put this trade on and it immediately goes to 205, then you're going to start seeing yourself lose money in that strategy right away. If on the last couple of days it starts trickling down there very slowly, then, you know, and volatility starts jumping up, then you could conceivably still be making money on that, despite that you're losing money in the front month, because volatility is going to be affecting that further duration contract that you're long, and you'll be making more money there than you're losing in the front month. But it's very difficult to really say exactly. There's so many different things that can go into that that it makes it difficult. If it went to 107, then, you know, and we were doing that lower strike in the SPY, then those front month expire worthless, and you would basically have the best case scenario in a sense. What if the market took off up or went down quickly? Then we'd lose on this strategy. Yes, this strategy, we do not want a very quick move. A very quick move will, generally speaking, cause us to lose the money right away. And then you just want to kind of get out of it. You know, maybe for 50% of what you paid for it. So if you paid 80 cents and you can get out for 40, if it made that real quick move, then that might be what I would look to do. So what else we got? What is that on the right side of the chart? Everybody always asks about that. That's my market profile or volume profile, monkey bars. It's basically where the most time and volume has been spent on any given underlying. So this is the point of control. This is where value has been discovered for Goldman Sachs. So a lot of times when it gets overextended, it wants to migrate back to those. I've done a couple of videos on that, so you can check out the archives and check that out. I don't really have the time to go into that, but that's the idea. Is this is where price has been discovered. That's where the most buys and sells have happened and the most volume. So in this, you know, this volatility is a little overinflated for this strategy, I think. Okay, I'm going to have to scroll up because we've got a lot of people in here today and there's a lot of stuff going by. So the next one I think I saw was Starbucks. And I'm actually, this is a good scenario for Starbucks. You know, if you watch the Fibonacci levels right here, you know, it's been bouncing against that and failing, so that could be an idea. I'm slightly bullish Starbucks because coffee prices are really low with that. So what's the implied volatility percent on this? So 23, so that would work. And so in that we would go into the July. We're going to want to sell the 104. So first look to see at what the difference is here, July to the August. So 6.4, so that works out pretty good. And then in the August, we'd want to go down here and then buy these. So $1, so, you know, we can expect that this is probably going to be $2 at that strike because that's going to be about what our max profit is. So $1.50. So we're going to be risking more than 1-to-1 on that. Looks like, I mean, just from a ballpark figure on that. So we'd be buying that one, selling that one. So we'd obviously want Starbucks to go up a little bit before it comes back down, because we're right there at the money, so we could get that front month to expire worthless, and then we would basically get $1.60 for it. We'd get about $1.60 for that long put, which would mean that we'd make about 60 cents on that. So that's why you kind of do that. Once that one expires, that's kind of about what that one's going to, our August is going to be worth at around that time. Okay? It's a pretty easy strategy for all intents and purposes on this. Okay, so the Starbucks on the what's the question here on Starbucks chart? Can you point out when to buy a call calendar and when to buy a put calendar? It's all on your directional assumption. So in my eyes, my directional assumption at Starbucks is bullish, but you might very well be bearish because you could say, well, it's up against this Fibonacci. It's going to want to go down to the 50, or this support level. It all really depends on your directional assumption as to when you're going to do this. If it's going to trade sideways for quite a while, then that would be a great case scenario for doing this strategy as well. And we got the event happening relatively close to the beginning of that month, so we could really see volatility start to expand in that month, because it's going to affect that month, because when volatility expands, it affects the month that it's that binary event, and a binary event is just a known event that could cause volatility, basically. So it's going to affect this one, because this one's not going to be affected because there's no event in there. So volatility could expand during that and would be able to cover this relatively close to expiration and not have to take on that event risk. Let's see, I think there's a couple other, I think I answered everybody. All right, so the other one I saw was Walmart. Walmart could be a good one. I know Walmart has a lot of open interest and everything else. I'm short some calls in there. So I did the, you know what, I did this for the call calendars webinar. All right, so then in this regard, I probably wouldn't normally put it on, but we're going to want to sell that one and then look to buy this one, which is right just out of the money, which is usually what I opt for. And $1, and then you can kind of flip to this and look at your expected 35 days to get 31 cents. Not that great of a deal. And then look at the chart kind of thing. So if you're bearish on it, and this goes into that where it's getting a little overextended, I have a tendency to believe that Walmart's kind of like going to be the only retailer surviving Amazon sometimes. So you could think that it would want to come back down and test this value area. I have a tendency to think it's going to kind of fill this in and create a big arc here. So that's how you would set that up there for that one as well. So the most you could lose on that strategy would be $1 on that. Somebody asked about Costco. So Costco also has a position in there. And it doesn't have the August, so I'd probably skip that one. Oracle was another one. Oracle, ticker symbol ORCL, and it's a $40 stock. It has 2-cent wide bid ask. Is a weekly play reasonable? Short near week, long 2 weeks out. I usually don't play that. I usually use this strategy and kind of roll it throughout time. So I would start out in the monthlies and roll this out. The reason why is because I don't want the theta, the theta decay anytime is going to outpace in the nearer term. Theta decay is the theta, and that's how much the option's going to decay per day on that. And as you can see, the theta decay in this month is 2 cents a day, and this is 1 cent a day. So you would get theta decay of 1 cent per day all in. And that's going to happen in the weeklies. Generally speaking, I don't play a lot of weeklies unless I'm doing an earnings trade or something like that, or I am rolling out in time defensively. And that's, Oracle has enough volume and open interest in there that that you will be able to see the weeklies even having pretty decent open interest and volume. I mean, Oracle may not be the best example, but when they have those weeklies, as the front month kind of rolls out, those weeklies start getting more and more. So we could look at these weeklies and see that they're getting a lot more volume and open interest going on the closer they come. So that's where we would probably be a comparable roll into something like this during that time frame, if that makes sense. Once these are decayed out and are zero the last day, then I wouldn't wait that long necessarily, but you can see that these weeklies are getting a lot more open interest or liquidity than these are at this time. But once these are in that type of time frame, that's what you're going to see relatively. So Brent's asking, yes, do I adjust these? If it's a losing position, I do adjust it, and that the adjustment would be to roll that out from July to the July weeklies and try and get a little bit more credit for it to increase my break even on that. Or the other thing is, since it's a defined risk strategy, you might want to just wait it out and let that, especially if you're really bearish, let that front one get out of that front one if you're in the money, and then let the other put ride. But remember that you're kind of increasing your risk parameter by doing that, because if you take off that front one and the market starts rallying again, you can increase your losses. You need that market to continue to go down to make up for that. So if you leg out of it and just get out of that front one or let it expire, well, you wouldn't want to let this expire in the money, because you're going to get assigned and everything else. So if you covered it though and didn't cover the whole strategy, you've increased your risk parameter on this, because if the market rallies up, that premium that was in the money is going to decay quickly. So the only way I would do it really is to roll that out in time, because you knew your risk getting into it. Why increase that risk and possibility of losing a lot more money than you initially wanted to? I would roll it to the same strike, yes. Because it goes with its, we knew what our risk was getting into it. That's what we're going to try and keep that at our risk parameter. Is gamma a risk close to expiration? Absolutely. Gamma is going to increase the closer you are at expiration. So I don't know if this will be a good example, because so if, as you can see here, I don't know why that says $1.13 for gamma. That seems a little steep. Let's see. So the gamma, the closer you get to expiration, as you can see, this one is 32. They won't have it. So let's look at a comparable 26. Actually, let's just go to the 40, because that's in the money. 40 is 32 there, and then 28 days out, you can see the gamma for the 40s is 18. So, especially if it's, you start seeing your option in the money, you're going to kind of want to squeeze this out, because that gamma will affect it rather quickly. And, you want that gamma to, if the market's, you're just out of the money. You want that gamma to help you out, especially if the market pops higher. That gamma is going to help you out there, and it could hurt you if the market starts going down at the end there. You know, the only time that I would maybe take this off, like legging out of it kind of thing, is say, for instance, the market really rallied and I was able to take these short puts off early for like maybe a couple of pennies, you know, less than a nickel, because then you're only really increasing your you're decreasing, in a sense, your break even, because you're adding to it, right? So if our original collection for this front month was $1.05, let's say, and we covered it for 5 cents, well, we've increased our break even to the downside by 5 more cents, which, you know, in that regard is really nothing. So that would be the only time I'd really take it off, is if we did this and the market just rallied. I could take those puts off, the short front month puts off early for maybe a nickel or a dime or something like that, and then hope that it really comes back. That would be the only time I would really just take off that front month and leave it that way. If it's in the money, I'm not going to do that, because then I really increase my risk parameter. But if it's, you know, looking like a big loser because it rallied up right away, then I might look to take off that front month rather quickly. Okay, so I think since we're getting down here to the end real quick, let's look at Yahoo, because I think Yahoo has a really good setup. Yahoo, I mean, unless you think Yahoo is going to turn itself around rather quickly, which I really don't see, and it's been trading nicely right within this. This could be setting up for, you know, if the market comes down, for a nice setup. Let's close that one out. Look at the implied volatility percent. It's right there at around 32. That uptick since today. So 35 to the August is 38. So that's within that whole 5% wide. Yeah, Cindy, we can look at gold. Gold has high implied volatility though right now. So let's open up those, and you know what, I don't need all of these contracts open. I can probably do it 14 since I'm just doing at the monies. So in this, we're going to look to sell this one because it's just out of the money. The 37, you know, this would be a pick 'em almost, because the 37s really could be the ones to do. Had a down day. I'd probably pick the 36s, but that's kind of a pick 'em because it's right in between there. So that would just kind of depend on, you could even set them up, both of them, and look to see what you're paying less for. So that's, you'd be paying 84 cents for that. So let's just look at the 37s. Yeah, so that's what I mean. That's kind of a pick 'em there. You know, if you thought the market was going to go up a little bit and those would go out of the money, maybe go up and test that high there, I might do that one at the money for that. And it's a little bit high on that IV percent, but it is trading quite nicely sideways. But in that, you know, if it continues to go sideways like that, we could see the volatility come out. So I'd like to find something that looks like this with really low implied volatility and looking for a move. Cindy was asking about gold. And I just put on, so the gold here is, we'd be wanting to sell this one, and it has higher volatility in the front here than in the back. So actually, you know what, this one might work out pretty nicely, because You know, this is paying more because it has higher implied volatility. And then we're going to be buying that one. So $1.04. And then you can kind of flip back to this and look, well, that is that's a nice risk reward. And the reason why is because there's so much higher volatility in the front here. So Cindy, that was a good one. I wasn't thinking that it was going to be a very good example, but it is, because the volatility is so much different, you know, by almost 1% from that one to the, from over that. It was more than that, wasn't it? 2%. So that increases your profitability, because when these expire, the back months are looking to have around that kind of premium in it. So, you know, you're basically going to be risking 1 to make 3 in a sense. Right? August. All right. Does that make sense? So it's a pretty simple one to set up as long as you fit the rules on this one. And, you know, so at $1.04 debit, I'm going to be looking to cover this one probably only for about 35 cents. So if you're bearish on gold, then that would be a good one. A good example. Are there any more questions out there? All right. Stage order over the weekend for Monday. If one can't place the trade on Monday, can one stage the order over the weekend for Monday? Pros and cons. The pros, especially with like a gold, the pros and cons of that is gold has been, you know, has gaps up and gaps down. So the last thing you really want to be doing is doing that. I don't set it up beforehand. I usually just try and get in there early in the morning. Maybe you could do it like, I don't know what your time frame is, but you know, you can set it up early in the morning when you get the indications. You can just, for like gold, and most of the other ones have pre-market indications as to whether they're going to be up or down, but you know, play around with it that way. Just go into the underlying and see on the trade page up here at the top, it'll tell you right here, you know, I'll say where the last was. Basically that's where it's kind of settled, and then where the bid offer is. So like you can see here, the bid offer is a little bit higher now. So that's where I would go to look to enter that before the market. I probably wouldn't do it today or something like that. And yes, Nick, the green line is the 50-day SMA. Would you trade VXX for Brexit? I don't trade the VIX, and I just don't. I don't really like to trade the leading indicators, and that seems to be a leading indicator. I've just never really traded it, and I don't know why. I just have always stayed away from it. Just looked at it as an indicator for the most part. How high will gold go? Is that what you're asking, Cindy? Well, you know, I mean, theoretically, it's undervalued compared to, platinum is undervalued compared to gold. So the real trade is really, in my eyes, selling gold and buying platinum, because there's a much less limited supply of platinum and much more uses for platinum than there is for gold. Gold is really just a pretty product. Gold IV, well, okay, so most, she's asking, gold has very high IV now. Is it still a good trade for the Brexit? You know, IV and gold, as gold goes up, implied volatility in gold goes up, whereas most markets, you know, the Walmarts or Teslas and stuff like that. When stocks go up, IV usually goes down, because that IV is implied volatility is a fear indicator. So gold, when it goes up, that's because fear is going up, and it's the flight to quality, if you will. So then fear gets pumped into that when gold goes up. As you can see here, as this market started spiking up, gold goes up. When gold goes up, volatility in that underlying goes up. Whereas stocks, when they go up, fear goes down. So I would, worry about it expanding, which I do. I mean, I have positions on in gold, but I thought with this particular setup, we rallied up, and just feels like, to me, it's getting a little long in the tooth, because it's above this value area, and once it gets up into that, basically it has a tendency to lose a little bit of interest for the most part, and thought it would at least come down and test this. That's just based on a technical analysis type thing. But the Brexit could very well increase the consumption of gold as a safety from currencies. So, all right. All right, well, that's about wraps it up, I think. I had on the 124 August 29 call spread. Should I sell the 118 put? You know what, I'll look at that in a minute here, but let me settle this up here in a second. So anyway, this is the, for you guys participating in this, we're, for the people that signed up for this, get the, for today, basically you're getting around 20 videos, and this doesn't even list all of them. Let me pull up the whole website here and look at this. So, so this is a special for you that are participating in this for today. And you get how I set up the screen, how to measure your delta, which I kind of briefly touched upon it in this video, all the different ways that deltas used for probabilities and things of that nature, and how to use the theta decay, time decay in your favor. We even touched on the gamma and how to trade options using gamma, and gamma scalping for the most part, and using that market profile, which I was asked about for trading, which I go into more detail about how to set it up on your platform. That's that blue that was on the side that has the little numbers in there. It was something that we really used on the floor a lot, because it's important to know where price has been discovered, where the most people had transactions going on, because that's where perceived value is. And when it gets past perceived value, people start losing a little bit of interest in it, is the idea there. And options terminologies, things of that nature. So there's a lot more that goes into those. Even the history of options, I go back to very beginning, the first guy to implement the use of options. So you can check that out. You can get that at, just reach out to us at trading@protraderstrategies.com, or you can call us at 310-598-6677. And if you have ideas on future webinars that you guys want to see different option strategies on, then please reach out to us with those, because we'd love to do them if I haven't covered them. All right, that's about all I got for you guys today. That link is in the chat box, so you can click on that. It'll take you directly to this page here that you can sign up for that strategy. Okay. Good. I'm glad to hear it, Alton. Thank you. Appreciate all your kind words, everybody. All right. I think that's about it. Just want to thank you guys all for participating in this, and like I said, we're going to be drilling down on some other option strategies coming up. We're going to be doing some that I haven't done, so please check that out. All right. Thank you. If you can't take that, take it easy.